Have you ever wondered if your pension could actually buy your business premises? It's a seriously powerful financial move that a lot of UK business owners just don't know about. In this guide, we're going to break down the HMRC rules for using what's called a self-invested personal pension, or a SIPP, to invest in commercial property.
And we're able to do this thanks to the specialists at Pro Tax Accountant. We've tapped into their expertise to give you a really clear and practical look at how all this works.
So let's get right back to that huge question. Can your pension really buy the building your company works from? Well, the short answer is absolutely yes. It's a strategy that can unlock some incredible tax benefits, and we're about to dive into exactly how you can do it.
Now, the key that unlocks this whole strategy is a very specific type of pension, the SIPP. So let's take a look at what makes it such a unique and powerful tool for property investors.
Okay, so what is a SIPP? A self-invested personal pension is a government-approved pension that, well, it puts you in the driver's seat. See, unlike a standard pension where someone else manages it all, a SIPP gives you direct control to invest in a whole range of things, and most importantly for us today, that includes commercial property.
HMRC is super clear on this one. Your SIPP can hold pretty much any kind of commercial property you can think of. Offices, shops, warehouses, you name it. But, and this is a big but, there's a hard and fast rule against residential property. If you try to put a flat or a house in your SIPP, you're looking at massive tax penalties. We'll get to those in a bit.
All right, let's get to the really exciting bit, the tax advantages. This is where using a SIPP for property investment becomes an absolute game changer.
First things first, let's talk about putting money in. For the 2025/26 tax year, the annual allowance is £60,000. Now here's the magic. If you're a 40% taxpayer, that $60,000 contribution actually only costs you $36,000 out of your pocket. The government basically tops up the rest. It's an instant massive boost to your investment pot.
And here's the next incredible perk. Once your SIPP owns that property, any rent it collects, even if it's your own business paying that rent, is completely free from income tax. That's right, 0%. Every single penny goes straight into your pension to grow.
Oh, but the tax benefits don't stop there. Let's say down the line you sell the property for a profit. Normally, you'd be looking at a hefty capital gains tax bill. But when the property is sold from inside the SIPP, the tax is also zero. The entire profit is yours tax-free.
Let's see how this plays out in the real world. Meet Elowen, a cafe owner. She puts £50,000 into her SIPP and instantly gets a £12,500 top-up from tax relief. She uses the fund to buy her shop. Then her cafe business pays rent to the SIPP. That's $15,000 a year in rent flowing directly into her pension, completely tax-free year after year.
Okay, so the benefits are pretty clear, right? But what about the actual process? How do you do it? Let's walk through the step-by-step roadmap for making this happen.
It's really a 6-stage journey. It all starts with choosing the right SIPP provider, because not all of them support direct property investment. Once you've funded and found a property, the due diligence phase is absolutely critical. Getting a professional valuation is non-negotiable. And it's good to know you can even get financing, borrowing up to 50% of your SIPP's value. Finally, it's all made official with a formal, market-rate lease. That last step is legally vital.
Here's another really powerful example. Idris, an electrician, uses his SIPP funds, plus a loan, to buy his workshop. Now, his company pays rent to his SIPP. And this is where it gets really clever. That rent payment is a tax-deductible business expense for his company, so it lowers his company's tax bill while his pension gets the income completely tax-free. It's a perfect financial circle.
So, we've talked about the opportunity and the process, but we absolutely have to talk about the flip side, the strict rules and the very real risks involved. This is not a strategy you want to take lightly.
Just look at the difference here. When your SIPP owns the property, rental income and capital gains are tax-free. If your company owns it, you're getting hit with corporation tax. The SIPP also has some huge inheritance tax benefits. But here's the big trade-off: liquidity. A property in your pension is locked away until retirement. You can't just sell it and get the cash easily.
So, what happens if you break the rules? Well, the penalty can be absolutely devastating. For a serious breach, like trying to hold residential property, HMRC can hit you with a tax charge of up to 55% of the property's value. A single mistake could literally wipe out half your retirement fund.
And don't think for a second these are just theoretical penalties. Listen to this. A business owner was found to be undercharging his own company on rent by just £10,000 a year. Because it wasn't a fair market rate, HMRC saw it as a rule breach and slammed him with a £120,000 tax bill. It's a brutal reminder that every single transaction has to be done by the book.
And on top of the HMRC rules, you've got your normal investment risks to think about. Property isn't like cash in the bank, it's illiquid. Property values can fall, which would directly impact your pension's value. If you've borrowed money, you have to make those repayments whether you have a tenant or not. And don't even get me started on VAT. That can add a huge upfront cost and a whole lot of extra paperwork.
Okay, we have covered a lot of ground. So let's boil it all down to the 5 most critical takeaways you need to remember.
First, the big one, SIPPs offer incredible tax breaks on rent and gains. Second, you can borrow up to 50% of the SIPP's value to help you buy, but remember that adds risk. 3, leasing to your own business is a great move, but the rent must be at a fair market rate. 4, follow the rules because the penalties are severe. And finally, number 5, always remember that property is a long-term, illiquid investment. It has to fit with your retirement goals.
Which, of course, brings us back to the final, most important question. When you weigh up these amazing benefits against the very real risks, is this the right path for you?
And honestly, that is not a question you should try to answer on your own. The rules are just too complex, and the financial stakes are way too high. Getting professional advice here isn't just a good idea, it is absolutely essential.
For anyone who's looking to really explore the strategy with an expert guide, the team at Pro Tax Accountant, who helped make this whole guide possible, are a fantastic resource. Thanks so much for watching.